Fly right into the future. We're gonna on my feet. No, not as much. There's another one too. Probably LGBT. Oh, no, was it something else? Yeah. I only had like 100 anyway. What the? There you are. Sweet. So. Okay, so these two are going down. I want to see DWAC and weather's going to go up to 55. Went up to 50, went straight down. All right, what was up? There's two bio stocks. Oh, where's the chat? Good morning, guys. Good morning. I hope you enjoyed your weekend. Today's dead. But I do see some things that I would trade, but it's not ideal. Other than that, Steven says the market's dead. I think he said it twice. Yeah. Salutation. So with DWAC, actually, I feel like this is going to get some volume today, especially since it went up to 55 in the pre-market. Is that the pre-market? Hold on. Other than that, it also had some news on I think it was Twitter. I saw someone say something in the chat about like Trump saying something on Twitter. And whenever you have a president or someone like really famous say something, oh, his $1 billion investment from SPAC. But I still haven't like verified that yet. But just the just him saying news about it in general is gonna try to spike it up, is what I'm going off of. I just want to see how far it goes. I'm not really planning on trading it unless it does get enough not even about the volume, but like more of like if it goes up a lot in a very short amount of time, then I might risk something pretty small. Like I don't really see it getting to 60 today. If it was going to go past 60 today, it would have did it in the pre-market. And oh, there's another thing. There's something that went up in the market because it was a merger. It was a Jack in the Box partnering with Taco. Yeah, that's what it was called, Taco. Del Taco. Was it Del Taco? Yeah. This is one of those. Okay, it doesn't look right on there. Taco. I think I can. So remember how we talked about it's not a good idea to trade stocks that just gap up with no volume slash, like there's no actual I don't want to say translation, but there's no actual like evidence of like the jump. Similar to like a reverse split, a merger, a split, and like things like that. Taco, that's what it did. It went from 7 to 12, based off of the news. Where's my other one? Oh, I have 3 of these up. That one. Based off its mergers news on the 6th. Something's off here. Did I put the wrong ticker? No, I did. Yeah. This isn't the one. Oh, and we'll go over that. But it was something else. Oh, let me see. Great ticker name, by the way. Yeah, there's a lot of food. Yeah, food in the top gainers today. I saw someone say something about Shake Shack. That was my go-to at the airport. And Del Taco. I went there like at least once because it was next to a dispenser. Other than that, Jack in the Box. Yeah, that was like high school right there. And so I realized how unhealthy it was. Whoa, look at that. Oh, well, it's still a $40 stock, so. Another day of like sitting on our hands. Nothing ideal. But I really wanted to say something about the taco. Or I probably could just be hungry. But the ACET, that was something else I wanted to look at. ACET. Because like this and ISG, they're bio stocks, and one's a micro float and the other one's like barely meets like minimum volume. Yeah. Oh, and I saw someone else think that CFVI was I think they thought it was like a gap through, or like it had the potential to be one. I was kind of confused what they were looking at, but as we say, back to this. Where's the one that comes up in the middle? Oh well, I'll just hide it later. 9. Something I wanted. Oh yeah, I remember. I thought this one up to 59%. I don't know. I looked at a few things today. Again, nothing ideal. But it was still something like I just wanted to check how it opens. Oh, I remember what I'm forgetting. I started looking at the float of each one of these. And let me put it up here too. I need to merge these somehow. There we go. Wait. Thought that would work. Oh well. Not that important. Anyway. So I want taco. I want ACET. Control back. I'll throw DWAC for, I don't know, shits and giggles probably. there is, oh, I remember. ISGI, I want to say. ISIG. And ACUT. I'm mostly trying to look for stuff that's going to pop up on the scanner in the first like 15 to 20 minutes. Not really looking that hard, but I just want to see things develop. Other than that, yeah, this weekend all I did was I didn't party as much as the previous weekends. I did study a lot. I narrowed down a lot of my my notes, and so it was hard to sleep last night because my brain was just going 100 miles an hour and it couldn't stop. It was kind of annoying. Other than that, from your experience, what is the minimum volume that should be traded in the pre-market / intraday so that we can go in and out? So the recent statistics is like 20 million is overcrowded. Before the minimum back in like 2019 and 2020, around like that area, it was like 3 million to 2 million was like the bare minimum. Because when you get into the like the hundreds of thousands, if the float isn't small, there isn't going to be enough liquidity for you to get in, and it's easy for you to get trapped. And then it's, you know, it's very typical for those kind of stocks that don't catch a lot of volume to get dumped like right before the open, and you don't want to be caught in that. Wait, let me put this over here. Yeah. But with what do you call it? ISG. This is the one that is a micro float. When I said something about trading, or like if I did trade something today, I guess I'm just like addicted to these things that are dangerous for me right now. I just wanted to see, like, if I, you know, in my mind or hypothetically dip bought this, would I win? This one and ICET. I'm not actually going to do it just because this is a dip buy, and I'm trying to be more disciplined with my shorting. But I still like to play the game. Because what is it? I think this one is on SSR. This one is a micro float. And this one has a decent sized market cap. So it's going to move a lot slower, but they're both biotechs. So if anything, I just want to see how the sector's performing compared to its tickers in the top gainer. Other than that, is there something else I'm forgetting? Yeah, there's something. Oh, I haven't pulled up my notes. Yeah, my account right now is at 29K. I think the last 2, maybe 3 days we didn't trade. And so like that's all just from borrow fees. Oh, yeah. The holidays especially like December, there's supposed to be like a bubble, because that's usually what happens. Well, actually, last year it was kind of crazy. Um, Everything had volume, even the things that normally don't have volume. Uh, and it's this year. It's actually more similar to the year before. And so, if anything, it kind of feels like a correction or like the calm before the storm. Like, I can't really tell which one yet, but I just know that I want to build that discipline now so I can survive that potential storm. And there's something I'm forgetting. Oh, I remember. CFVI. So with CVFI, I heard someone say it was like a gap through resistance. Well, let me look at the daily first. Cool. So if it's a gap through resistance, first we need a resistance. And okay, this is actually pretty recent. I don't need to go farther, that far back then. Oh, okay. Why does it look so intimidating? Like, this drop looks big for no reason. But the closest thing that you would be able to use for resistance would be the 10 to 12, and then pretty much use the, is that 10? No. Why is this? Why do these candles just look so big? But okay. So I think they said it had 80 million volume. I don't know if I would trust like this 10, 11 as like a resistance area, and pre-market is usually not a go-to. But you know, if I try to combine both of these, I probably use 12 as the as like my starting area, and then going on that idea from like, you know, a day before, found some support here, slowly grind it through whatever resistance that was there, then took off from that 12 area. You know, it does kind of make sense. Because like this closed at like 11.50, which is 50 cents below on a $12 stock below that. And you know, if we're only looking for, what is that, 60%? So about 19. Yeah, but it would have had to get a lot of volume. So it would have actually, since this by itself wasn't as ideal in terms of like the resistance created, like because it wasn't dense enough, the volume wasn't there, like in the not in the first place, but in like the most ideal situation. It's like you're at 100 million, but at least like 30 million of that is kind of useless. You don't want to exceed that too much. You still want it to act as like a magnet to bring the stock back down, but also go up to 19. And that just seems really hard to do within like 70 million volume. And so overall, like, plus we don't even know the name of the sector. Like, there's so many like little factors that just add up into whether this is a something worth watching. So finance, shell company. Okay. A low float, upper market cap. Let's see. Oh, that'd be 20, 20, 20, 20. Where you at? 20, 20, 20. and the high market cap 20. So it'll be between these two. I think it's this one. So generally, we'll be looking at something closer to range up, like 60s. Let's see. I prefer more data, but we're looking for something that at least goes up 60%. So like on the range created that day. Is that with the resistance or without a resistance? Okay, looks like without a resistance. So SPRT, I'm pretty sure that's delisted. Okay, this is back from March, and so that's. Oh well, won't go too much into that. Let me ask some questions, or no, let me answer some questions. There we go. In your opinion, how much of the percentage split in the aftermarket / pre-market spiker is from shorts versus longs? Well, it really depends on the day. Because if Steven took their money the day before, it's probably the opposite of the people he took the money from. But that's just like a very general sense. There's all kinds of like little things that you can do to gauge based off of standards that you personally set based off of your foreknowledge or like your knowledge of this is something practical. It's always easier to give an example, but I don't want to be too. I want to baby everybody. How do I say this? Okay. How much of the percentage split in the aftermarket? Percentage split / pre-market spiker is from shorts versus longs. Oh, okay. That's kind of a different question. I probably misunderstood it. So you can look at that in terms of shorts don't like to hold overnight because the way you look at it is shorts, they take a bit of the supply and they, what do you call it? They attack the bid and they have to eventually give that supply back. And so I know there's a visual I have of this type of stuff. I think it's shorts theory. No, that's not it. I think it's like market something. Yeah, but pretty much 15 to like 25% is but it's all kind of like situational and depends on like the specific ticker, the recent price action. Like it's not an exact science. It's more of you have to create what you think dictates that. In my case, I usually just give a rough example of the shorts taking about 10%. Up to like 20% of the entire like supply, and most of the people are going long, unless it's a easily recognizable. This is a shortable ticker, and then that's where it gets closer to the amount of money that the shorts have is equivalent to the amount of longs, but the amount of people is always in the favor of the longs, and so you pretty much have to gauge the quality of like the short sellers like accounts. And so like if you're looking at longs and you see they have like a lot of smaller accounts and they just add up over time, but you're looking at the shorts and all of them are just rich unless they recently just got squeezed like in previous like weeks. You kind of have to play with that balance. And so how do I say it? It's just recognizing the type of tickers that each one of them trade on, and then pretty much like jotting that down in terms of like relative context, if that makes sense. So if it doesn't, sorry. But I know I have a visual of this type. Oh, it's probably in my trader analysis tips. Okay. Okay, I know there's something I can put in here for that. I know it's something with theory in the name. That's not it. Oh. There we go. Not this one either. Swing story? No, not that. But pretty much, it's easier to gauge how many shorts and stuff there are on like a Friday, because you know they're not going to hold overnight. And then you'll just be like, oh, okay, what's this like random spike in the aftermarket? And then it's something similar like in the pre-market where there's some people that their edge is in the pre-market. And so you have to have a decent idea of how many people like they are versus like the late hours, like the last hour to two of the aftermarket. You have to find some way to differentiate between like the last 2 hours of the aftermarket and then the first 2 hours of the pre-market. And it's really hard to like say it out loud and like make sense of it. But most of the time the shorts, they give all the supply back before like it gets to that point. And the longs, they're the ones that once there's like a support found, like between that like 4 hour range that I gave, you can kind of see where the longs are going to take over, and then like all the shorts like leave until it gets to a certain amount of extension, and then that's how you can generally tell how many longs or like how much momentum, and like it's kind of like a little bit of both, or at least that's how I look at it. There's oh no, not that. Big boy theory. Okay, I know what I was doing. Let me take this off. So pretty much in this like theory, I was viewing like a lot of samples of like low floats, mixture of like my personal data and like Steven's data, and I was trying to figure out where everyone was, and pretty much I was trying to figure out like where the biggest seller was, like in overall, how do I say this? In like when you put every type of gap up short together, and like the potential variations, I'm just like, okay, where would a rich guy go in? Where would a medium or middle class person go in? Where would blah 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 go in? And like this is originally how that ended up, and then that turned into like I think simple stats. But like that's a general idea if like you wanted to do that. Yeah, this is like very early things. Like I'm way past all this point, but it's kind of fun looking back through it. Ah, I knew something was off. I forgot. Music. Can you explain market manipulation? What who, what, where, how, why, And is it intentional or is it just random hive mind thinking? That's a good question. So it's kind of a little bit of all of it, and you just have to recognize the state of mind, the temperature, the recent temperaments of the traders. The let me turn this down a little bit. Well, it's not even up that much. But what was I say? Yeah, so the who, what, where, how, and why. So the who, that's the first thing that you have to learn, like when you get into like the trading. Who are the players? So, well, I'm not giving out this one. This is my favorite one, but and that's for StockCraft. This is my copy, but earlier version. Learn the players, and Tim's like, oh, who are the leading fakes? Older traders, hedge funds. Alex, a good trader in the chat. What is this? Oh, this is my homework. Okay. There are several big players in the stock. I know I have like something better that I can use. Okay, so pretty much you want to create a standard, and you want to make it based off of the account sizes that have an influence in the stock that you're trying to trade. Because at the end of the day, you want to select a pattern, like a specific pattern. Once you have enough data, you're going to see what's your like preferred range of like market cap and float. And once you like narrow all that down, you're going to study it with like enough data points that you're going to start seeing the key points. And when you wait, I need to take this off. Stop putting that one up. But you get to a point where you'll be like, okay, the biggest guy in the room, he usually, if it's like a low float, he'll buy everything like before everyone gets in. And when you see that death candle, most of the time that's actually him exiting, or that's like, you know, enough people getting to the point where like they're impatient, and when he sees that little crack, he uses that as like a like pull the rug from under you kind of thing. And that's like just the who. That's just like one who. There's also the common average Joe dumbass, like, or like the average 5K account, $1,000 account, $20,000 account. Like, you legit have to create your own abstract idea of like what it is, and then slowly make it like concrete. Let me, I don't want to give too much of this one out, but pretty much I created a working abstract of what a trader looks like, and I have about like 100 points where if I had the specific size account, or if I was you know, this person a part of this person's chat room and stuff like that, or if I was like this specific guru that was kind of not verified and like all this other stuff, what would I be looking for? On one side, it's a very objective, like you create your own objective, what you're looking for, like 10%, 20%, like a specific price action and stuff like that. And then on the other side, it's more of just straight blind determination. It's like a creative way to lose your money in like a gambling way, where how do I say this? Like you pretty much have to find the rational money and then the irrational money, and you have to understand the flow of both of them. And once you understand the flow of both of them, then you find the cross between the two, and you pretty much create a safe space. It goes in like that kind of area. But what was I say? That's just giving you the who. And so like when you recognize like the irrational money and then irrational money, like that gives you about like 5 up to like 8 different people. It just really depends on like who you're trying to target. Because at the end of the day, you kind of want to target someone, so you can get the most of what the most of like whatever their weakness is, or if you're, tracking the biggest person in the room or the most influential one, you want to be on his side. And you can do it. You can do it to the point where you can jump onto anything that he's attacking, or you can wait till he gets to a point where he's about to lose, and you could jump on the other side. It really just depends on what you focus on. And so there's so much you can do with this stuff. It just comes down to how efficient you are, how you focus, and like what kind of standards that you set. But that's the rational money. The irrational money, they're also easy to see once you have enough screen time. You'll start to see the cognitive biases is what I want to say. And like the failure to, like the undisciplined people, that type of stuff. And so like that should be enough who. What was the other one? When it comes to what, where, and how, I kind of gave a little bit of that too. The what is, there's only two currencies or resources that go through the market. That's money and then like mentality. So it'd be pretty much your money and then your focus. And if you can find some way to make that applicable to your strategy and, make money off of it, use your creativity mixed with your rough understanding of statistics, and I don't want to go too much into that. I might get in trouble. So what, where is it's really wherever you focus. And so like in Steven's case, he told everyone to focus in like the beginning of the market because that's where most of the volume is. And so that's the quickest, I know I say this, that's like the quickest, that's the most volatile point where you can like learn really quickly or lose really quickly. So the general idea is you want to learn from secondhand experience instead of firsthand experience, but eventually you won't even be able to be aware or perceive like certain stuff until you do have that direct experience. You just want to, give yourself enough knowledge prior to the point that you go in so you can scale. That's all I'm going to say about that. What was the last point? How and why? Statistics, experience. Why? The why would be, if you're in the market, you can be here for so many different reasons. You could be here because you're bored. But at the end of the day, all reasons are bad unless you're here to make money and then continuously make money efficiently. But there's a lot of people, they'll revenge trade. They'll come here just because a friend said it. So it'll be some type of, I'm trying to get closer to this person. Like you can come to the market for legit any reason. And that they all fall under the rational money. The people that come here for money, they fall into the rational money. And so it really just depends on what standards you set for each people. Narrow that down to its first principles and like emotions and overall theories and, principles and stuff, and then weaponize it. Like that's pretty much all it is. You're going to war every single day and you just have to effectively survive and then effectively find the best timing to yield, retreat, attack, etc. Now, what am I doing? Oh, yeah, that was a really long answer, but yeah, that's pretty much the gist of it. Would be nice to know common areas where the longs are chasing in aftermarket / pre-market. That's something that you can just look at least 100 points of data. And then you'll kind of just take the averages and you'll see where they are. But that's more of a zone or more of a moving range or that type of stuff. Each year, the first 3 months, you're going to have to pretty much gauge the temperature of like that year's cycle of like, you know, new traders come in, some are experienced, some are new. The ones that are new, they have the same tendencies, and you can just track those and then weaponize it. Can you explain market manipulation? Who already said that. Can you talk about how you estimate squeezing percentage? So when it comes to like squeezing percentage, first you need to know a pattern. And when you have your pattern, you're going to see ideal points in that pattern. And when you're in that pattern, there's going to be a point where things become non-ideal. When they're not ideal, that means the odds are not in your favor. And if they're not in your favor, there's a higher chance that it's going to squeeze. Go to the point where you think you would have traded based purely off your emotions or purely off your, speculation minus your factors or indicators that signaled this is good or bad. At that point, then track to wherever it squeezed to. Do that enough times, it's going to give you an average. And like, the average is going to give you a place to aim for, like an ideal situation. Other than that, using the same data, you want to have like a upper outlier / like estimate, and then a lower estimate. And so what do you call those? I think it used to be like a box and whisker, to where like one's supposed to be like upper range, lower range, and then like the average in between. Use the same kind of idea, and then try to like the trading. It's good to be rigid, but it's also good to be flexible. And so you try to have to find the fine line between, and then just practice what you preach, because that's the only way that's going to prove whether you're right or wrong. Hopefully that helps. All right. So there's something else I was saying. Oh yeah, I forgot. I want to cut that anyway. It's really just being realistic and trying to attack the unknown and possible. Yeah, I won't go too much into that. There's something I'm forgetting. Was it this? I took this position so long ago. See, this is why we don't trade those tickers that don't actually show it's spiking. I never did find the news for this. It's supposed to be like a merger between Jack in the Box and Del Taco. Is this getting any volume? No. There's some. Oh. SG. No. I remember this only being. Okay, so I woke up. No. Something else. Something. I'm forgetting. Oh, what I have my stats up. We're at the previous close. Oh yeah, 4.94. No. Oh, forgot about the questions. Do you believe in indicators, quant traders, future traders? Seem used to them a lot. Fibonacci, Boolean bands, etc. But I don't see them in the small cap world. Okay, so those are players too. Like you also forgot like market makers and the what do you call the algos and a few other things. But what do I have to say about that? So when it comes to penny stocks, it's very volatile and it's a little different compared to the rest of the market. Everything down here has really bad fundamentals, and so it's destined to fail. It's common to see something spike up and then go like back to where it came from within like 6 months, a year, sometimes a month. It really just depends on the amount of money and stuff like that. Because at the end of it, in like the bigger picture, you see the stock is here to raise money for the company. And then the company eventually has to take the money off the table once they raise enough money. We're not directly taking money from the company. We're more of what do you call it? We invest in the company and like they're trading us, and we're pretty much trying to find the realistic balance between like when they're going to pull the rug and then measuring the incoming flow of like money. And so it goes something similar to that. But when it comes to like, what you call them? Quant traders, futures, Fibonacci, Boolean bands, and etc. They have all their indicators and things based off of the stuff I'm saying too. But the amount of information that people have, this is where it becomes like creative and objective. You could be looking at the VWAP, or you could be looking at RSI, or like all these other very technical indicators, like with equations that do something with like fundamentals or specific liquidity divided by this amount of supply, doing some like fancy stuff. At the end of the day, if we're using like the quant traders as an example, let me pull up my stock graph stuff. The type of traders when it comes to quants, there's the mean revision, there's the trend followers that like they just follow the momentum. There's the statistical abridged based ones. There's the algorithmic ones. The behavioral bias recognition. This is the closest thing to what we do, where we just find the inefficiency in the frame that we put on there. We personally put on there. That's why you have to track your own statistics and etc. ETF rules, that's not as important. But the future traders, Fibonacci and Boolean band, they can all be classified in like one of these categories, and you'll see that we're all playing a different game, and there's several ways to lose the game, and then there's several ways to increase your odds of winning the game from the bottom up by eliminating whatever you can on your side from shooting yourself in the foot, as well as like narrowing down what is actually it's more of like a cross between the markets, a cross between what everyone's looking at. How would you call it? in like quant trading, in futures and stuff like that, when you like, I know Stockcraft has something really similar, or I created something the other day. Pretty much when you test stuff across like multiple markets, you'll see like when you test like one pattern and like one strategy across like multiple markets, you'll see there's like some type of commonality between all those markets you tested. Whatever that's like common there means that there's a fundamental reason that it did that. And you don't know whether it's emotions or whether it's like a very specific factor, but you know it's something concrete. And then if you can, you know, find what that concrete thing is, it just overall increases your odds. And the thing is, like, getting that concrete I want to say like signal or indicator, but like finding that it's again, it's objective. And there is still the possibility that other people are tracking the same thing, and then they're waiting for you to get trained by the market looking at that, and then just reverse the whole situation. And so it's really, it's similar to like playing chess. Like there's always something like you can do. Just be like, oh, I know the effective way to beat a beginner using like this specific strategy, and it wins every time. But if the master on the other end knows that strategy, all he has to do is let you win against like, you know, people 10 times, and then create a counter strategy for that one time, then blow you up. And then as soon as you make that first loss, now you're like within his hand and you're playing with you like that. So like it's hard to describe. It makes sense to me until I like say it out loud. But what was I say? Yeah, but like that type of trading, you can't. So like with all those tradings, they're rigid, like very rigid. And I say rigid because they get to a point where they fall off. And the way you can curve fit those, or the way you can, you know, increase your odds, is to pretty much get out of your own way, or bring in some other indicators that hit it from a different angle. And what happens is once you hit it from like enough angles, you'll see there's some stuff that overlaps, like a specific amount of like RSI, a specific point on the VWAP, you know, a certain amount of volume, like a little bit of everything. And then you pretty much make the most solid, robust strategy you can and build the way up. And like that's, I think I try to show some similar video in Stockcraft about that. Multiple factor portfolio, something like that. Yeah, combine uncorrelated factors and extract additional value for the portfolio. Yeah, something like that. And they called it alpha trading generation. And so it's something like this, except this is the robotic way to do it. This is like the rigid way to program it. Now, if you can do that in a more of like keep it in your head kind of way, or like make it a logic, make it a principle, make it a lifestyle, then that's where it gets like a tiny bit more stressful, but you might increase your odds. Hopefully that helps. And that's what Steven does, or that's at least part of the stuff he does. Yeah, structure, strategy, backtesting, execution, risk management. Yeah, and then mastering each one of these in the right order to where you survive, and then, you know, maximize your gains, minimize your losses. But there's something else I'm talking about. Thank you. Hey Dontez, do you happen to know how do we define market change so we can adjust the pattern criteria or adjust to the new market conditions? So each year the market changes. Usually in like the first month to like 3 months, really depends on how patient you want to be about it. Because you're always going to do some type of reset your statistics when you realize, you know, 3 to 5 trades, your stuff is like slightly outdated, or the total amount of money in the market's changed, and like stuff like that. And so you have to adjust it. So if I remember right, from I won't tell the source, but I think 66-day cycles was supposed to be like the amount of traders coming in. And like when it comes to like seasons, like you'll see like there's an on season, there's an off season, there's summer, there's winter, there's spring, there's fall, and they each have their like front end and back end. And I remember 66 being like the number that like comes to mind in terms of the cycle. And that's where like tendencies and stuff comes in. It's what I remember. Now let's see if I have like the source for that. I think I just put in cycle of effects, cycle in the market. Let's try that. Okay. I don't want to give too much of their advice. Let me cycle. Okay, so this is what I'm talking about, but this isn't what you're asking. So let me pull out a different one. Cycle. Yeah, but pretty much the cycle is I think it's like 66 days. It's something around like 60 days or 2 months. Like every 2 months you have to pretty much adjust to the relative price and the amount of money in the market, because like, you know, it kind of makes sense if you spent the winter where everyone's emotional trying to get money together. How come that keeps coming up? But if you're trying to get the winter like the holiday money, they're all emotional and everything like that. Eventually there's going to be a dead spot in the market where it like has to go down, and then people are going to have to come in. And like when they come in, you want to let them grow, because if they don't grow fast enough, they won't be able to like keep the flow of the market. Like, so what do I say? Like the reputation of the market by itself already brings in a certain amount of money each year. And then the people that actually like made some money, they're going to tell their friends. And like, you know, so every one person that made money on the market, they're going to tell like 10 friends. And so it's always going to be a constant flow of, you know, people coming in. Now the people that actually have the courage to fund the account, go in there, and then stay for X amount of time, giving it like 2 months, I don't know, it just kind of makes sense to me. But I don't want to like say too much of like the details. Yeah, but something around there. Let's see. Do you happen to know how we define market change? Okay, see, like when you define it, I know where like certain gurus would say in like their movies, but I'm just like, I don't think that's credible. I know the philosophy from Steven, and like I pretty much just gave you that. And when it comes to adjusting to new market conditions, that one's a little bit easier. Hold on. Someone's added me as a friend. Oh, okay. But to adjust to it, that's easier. You just take out a little bit of your like recent data that you feel like is a little outdated, and like you don't have to really like take it all the way out. You can more of just like put it to the side, and it could be used potentially later, because every year, you know, it's going to be a little bit different. But sometimes, you know, your previous year might look similar to, you know, a couple years from now. Or what do you call it? Not Gritani, but all those people that were like tracking stuff since like 2014, 2020, 2010 and stuff like that. The patterns and things like that, they look the same, but the amount of people change. And so like there's going to be a big cycle, and then there's going to be like several smaller cycles, and you want to be able to understand like where you fit in. And the only way to do that is to track a lot of data. And the thing is, you can narrow your data down into like whatever way you want to fit that year. So like that's pretty much all I have right now. That brings up the question, why don't people do that to Steven? See his patterns and reverse it on him. See, that's the thing. Once you understand how to, okay, I don't want to go too much into that, but just know no one out there is going to give you 100% of everything. They'll give you enough just to get you like interested and like enough to like, you know, make you self-sufficient. But there's points where the reason they can give it out so confidently is because they probably already have like the next step. And while you're over there trying to figure out the next step after the step he already gave you, he's already on to the next 3-4 steps. As at the end of the day, it's a human hierarchy, and you know, it's people versus people. And like, there's only 2 variables. Like I said it before, like there's money and then there's focus, or like mental fortitude and stuff like that. As long as you can stay in the top 10%, you'll be fine. And that just comes down to identifying where people are and then putting yourself in a position to, you know, thrive. So that's as general as I can be without getting in trouble. There we go. Roman, because Steven is the chess master. Yeah, pretty much. Yeah, that explains it. Like, everyone else is playing checkers, he's playing chess. And so like, you're focused on like, you know, lateral movement. He's focused on like, wait until you guys do 100 moves. And he's just like, he does 1 move and he's like, checkmate. And he's not saying checkmate to one person. He's saying checkmate to everybody. And so you're just like, unless you build a lifestyle around that kind of thing, it's hard to get to that point. Like at all. I mean, he pretty much built his entire lifestyle around that, like over like a large span of time. And so like, he earned his money. Most people can't do that, or they can't like afford to even start. And so that is pretty much it. All right, guys, it's 10:30. I have to go do some things and I'll get back to studying. Be safe. If you like what you saw, please like and subscribe. And I'll see you guys tomorrow. Peace.